All right. Well, hello, everybody. Welcome to the webinar. Let's go ahead and get started. We got the disclosure, so you can always check those out on our website. And we're going to talk about Nadex today. You'll be finding out what that's about. So there's a standard disclaimer for them. And we reference a whole lot of products, and so we have the registered marks disclaimer as well. And of course, we'll record this entire thing, and we'll put the replay up for you, so you can always go back and read those in detail. Okay? So the summary of risk disclaimers is, trading involves risk, and this is education, so make sure to consult with a licensed financial advisor before placing any trades, etc., on down the list. Okay? Module 7. So we're already halfway through the 12 modules, and this is going to be the last strategy module. So we're going to talk about option trading strategy, but specifically binary options and spread options, and I'm going to go a little bit into the platform. And then what I'm going to do over the next few weeks is I'm going to make a series of videos training you how to use this specific platform, okay? We've been discussing strategy, system, and style. System is the 12-step trading system using the one pattern for all markets. And, you can understand how to read the markets perfectly, but without a system, you can blow up your account, okay? Or you can have a great system, but if you don't know how to read the markets, then it's useless. And style is about how to read the markets. All those combined, if you don't understand the strategy, the basic instrument you're using, then, you don't know if you're using the best instrument, and also you don't know sort of the rules of the game. So we talked about that quite a bit in our past webinars. And really, we're going to focus on strategy a little bit in future ones, but we're going to be focusing a lot on style going forward, okay? We're going to cover a unique kind of spread. We're going to talk about binaries and how to access these instruments if you're a U.S. resident and if you're not a U.S. resident, okay? Because we have both on the call. Topics that we're going to cover. We're going to go, like I said, into... first what we're going to do is we're going to go into Nadex bull spreads, and I'll explain what that is. First thing I want to tell you is when you hear the word bull spread, immediately you think up. That doesn't mean up. So if you want to replace the word bull spread with day spread, because they're basically daily spreads, they expire every day, then that might be better for you. So if you buy it, then you're saying it's going to go up. If you sell it, you're saying it's going to go down. So the word bull spread is just what they name the product. Don't worry about that. It doesn't mean it's a bullish trade, okay? We're going to go into, how do they compare with traditional option spreads? And we'll also talk about, why they're better, in a lot of cases than using, outright Forex and futures. And I'll even show you some side-by-side comparisons of futures. We'll talk about Nadex a little bit, and we'll go into, what are Nadex bull spreads. We'll talk about the prices and how they change and the time frames and the products they can be traded on. We're going to talk about, what the spread ranges are and, how they're settled. And I'll show you some examples of spreads and the price change. And we'll talk about how they can be used to, avoid getting whipsawed, which is huge. This is where this really just kills other strategies like futures and Forex, because you can trade those same strategies with a limited defined risk. And so, like, on a futures contract, if you hit your stop loss, you're down and you're out. On a spread, if it hits your stop loss, you're down, but you're not out because you have until the spread expires before you're out. So it could actually come back up. And, I'll talk about that a little bit more in detail. And we'll talk about, you can use the one pattern to trade Nadex bull spreads. So, first, why trade Nadex bull spreads? Well, with Nadex bull spreads, depending upon the exact trade, there's different types of margin, right? So you have stock margin, you have Forex account margin, futures margin, even options can expose you to more risk than the original investment. Like, if I'm using margin on, say a futures contract and I'm only putting up, say, $500 to trade that future, but if the future is actually worth 120 grand, well, I'm risking whatever the movement is. So if it's a $10,000 move in one day, there could actually be a huge risk if I don't have my stop losses and honor them correctly, or even if there's a gap and I hold it overnight, things like that. With spreads, you will not have that issue. What they've done is basically they've made it to where you can trade those same similar products, but you have the potential to make large profits even on small moves in the underlying, okay? And you don't have to worry about the capital leverage in the negative sense, meaning risking more than you put in, but you still get a lot of that same buying power leverage that you get. So with a future, like you put up $500, but you're leveraging, $115,000 product. Well, with these products, you can put up the same or maybe even less money and still get the same dollar for dollar move depending on the trade that you put on. And I'll show you exact examples of how that works. The biggest thing is you only risk, the maximum risk is what you put into the trade. So if it costs you $100 to put the trade on, that is your maximum risk, even if it's a $400 potential profit. So you could risk $100, and if it goes, $300 down, you still only risk $100. Okay? And that eliminates the whipsaw issue. I mean, who out there has ever had them, you've got into a trade because, man, you're like, it's going up. So you buy, and then 2 seconds later it goes right against you and hits your stop loss, right? Nobody's ever had that happen. And then literally like 30 seconds later, the thing goes in the right direction, and you were right all along. But you were knocked out of the trade, and so you didn't get in again, or you missed out on the next trade, or you're shy because you just, you've lost all this money. Well, with Nadex spreads, it went down, it hit that stop loss, but you're not out. And so you get to have time to be right. And it allows you leverage without the additional risk, so you can still make a large percentage, potentially make a large percentage return on investment with a very small capital requirement. And you don't have to worry about the complexity of cents, pips, and ticks and all that stuff with them as well, because every point is worth $1. And I'll show you exactly what I mean by that. Okay? In addition, the spread options give you access to being able to invest long or short, but you get the limited risk while trading Forex, global stock indexes, and a lot of different futures markets. Okay? So how do Nadex spreads compare with traditional spread options? Well, on a traditional call spread, where you buy one call strike and sell another, then the difference is basically the spread. So if you bought a $100 call and sold a $105 call, then $5 is the value of the spread. Okay? Well, this pretty much works the same way. Whatever the strikes are for the spread, that's the maximum value of the spread. When you put on a put or call spread, the maximum risk and reward is completely defined. So like on normal options, if I buy a call spread, or I buy a put spread, or I sell a call spread or sell a put spread, my risk is defined. So if a $5 spread cost $1, then the reward would be the difference between $5 and $1. So it'd be $4 maximum possible reward. The exact same thing with an Nadex bull spread. So except for, let's say the spread is, $500, and let's say it cost $100 to put on the trade. So your maximum risk is 100, with your potential profit being 400. Okay? And, why do I say 100? Well, I mean, if you think about an option, in an option contract, you have to do 100 options per contract. That's how they work. So if you're doing $1, you're actually risking $100 to make $400 on just a standard option contract. So very, very similar. So again, just like the traditional call and put spread, your maximum risk is placed in the trade, so you don't have any additional risk. Big advantage. Unlike the traditional call spread, you don't have to worry about the exercising of options, as basically they're cash settled. What that means is whatever they're worth at expiration, you get the cash settlement difference. There's no stocks or commodities that are going to be assigned to you, or futures contracts that are going to be assigned to you. Okay, and they're priced really for retail traders. And retail, I mean, it could be a very large account, but meaning you can literally go in and with a few $100s you can start trading. So I think it's $100 minimum to open an account. Okay. In addition, unlike the traditional call spread, you have this extrinsic value that has a huge impact on traditional option spreads, where you have delta and gamma and theta and vega and rho and all this other stuff. We talked about that last week, on the last module on the options. But on this right here, you don't have to worry about that. There is a little bit of what you call optionality near the edges of the spread, but I mean, at the end of the day, it's basically almost point for point, dollar for dollar move. And you really don't have to get tied down in the Greeks at all. The biggest thing is you don't have to worry about time decay with the spread options. Okay? Now, we're talking about binaries. Time decay will have a big impact on those. But on the spread options, you don't have to worry about theta eating it away. Meaning, if I buy it when it's $10 in the money, okay, and later it's $10 in the money, let's just drop in the money. If I buy it for $10, and let's say the option expires, and it's at the exact same price as when I bought it, I still have my $10. Okay, less any, exchange fees, things like that. But I still have my $10. Whereas on a normal, spread, if I bought, out of the money, put spread, out of the money, call spread, whatever I buy it for, if it's not in the money by at least that amount, like if I bought it for $1 and it's not at least $1 in the money, I mean, it hasn't moved in my direction, then I'm out of that money. Okay? Now, of course, time decay works for you if you're selling spreads on an option, normal options. This way, time doesn't work for you, but it also doesn't work against you. It's really a neutral thing, so you don't really have to worry about the theta. And this allows you to trade the underlying without having to put up as much money, but also without having to worry about time decay. So the Nadex exchange, and we're going to talk about it. I'll talk about a couple different exchanges here close to the end of the webinar. So if you're an international resident, you can actually get access to very similar, if not the same products. Okay, and I'll tell you 2 different exchanges where you can go to get access to those. All right. And then I'll also post the links in the forum for you for U.S. and then for non-U.S. traders. Okay. The Nadex exchange is the North American Derivatives Exchange. It's a Chicago-based exchange, meaning it's inside the U.S. Your money is in the U.S., it's staying in the U.S., and they're an exchange. They're under the CFTC, which is over the NFA. That's the people who manage the CME and NYMEX and COMEX and all the big futures exchanges, okay? So they're not some, random company out in the Philippines. They're an actual exchange here in the United States. Complete transparency. They're not the market maker. A third party is a market maker just like any other exchange. Where a third party is the market maker, meaning Nadex is not trading against you, okay? You have completely defined risk when you trade on the Nadex exchange, because whatever the risk is, you have to put that up for the trade. And they're retail focused, so therefore they're really working towards the retail investor, so you can get in with very little money or, quite a bit if you want to do larger transactions. And a big benefit is, you don't have any broker fees. You get to actually be a direct member of the exchange. If you want to trade on the CME, you can either buy a seat to be a member, or unless you want to put up $100,000 or $1 million, or depending upon what kind of seat you're getting, you have to put quite a bit. So otherwise, you have to go through a company like TradeStation or TD Ameritrade or somebody like that to get access to the exchange and trade on it. Which means you have to go through a broker, which means you have to pay broker commissions. There are no broker commissions. There are exchange fees, but you know what? You get exchange fees on CME, you get them on NYMEX, COMEX, New York Stock Exchange. So you even get NFA transaction fees on Forex. But with the Nadex, you don't have any of that. You just have the exchange fee, and you don't have to worry about the commissions of a broker. Also, you're going to be able to trade a wide variety of markets, so you can focus on whatever you're into. So if you want to focus on stocks, they have stock indexes. So it's sort of like, think about ETFs, like the spiders. Okay, well, they have the S&P 500. They call it the US 500. It's the exact same thing in the sense of that's what it tracks. They have commodities like gold and things like that, and we'll go over all the stuff that they have. And they also have currencies. So you can trade the currencies. So whether you're into stocks or index futures or a variety of commodities or currencies, you can do that. Basically, when you're doing a Nadex bull spread, and again, don't let the word bull trick you. Just think Nadex spread if you want to. There's an option that allows you to trade an underlying if the underlying will rise or fall before expiration. So you're basically, if you buy it, you're saying it's going to go up. If you sell it, you're saying it's going to go down. All right? And this is similar to buying a traditional put or call spread. Buying the spread would be like buying a call spread. Selling the bull spread would be like basically like buying a put spread. Okay? So if you buy it, it's like buying a call spread. If you sell it, it's like buying a put spread on a normal option, except for you don't have the time decay working against you. So you can exit them before expiration, or you can hold them to expiration. If you hold them to expiration, they cash settle. Basically, the profit or loss is calculated on the price that it settles at, and you get the difference. Okay, and I'll show you actual examples of what I mean by that. Spreads can be used to trade in a variety of markets, like we already talked about. And the expiration settlement is settled depending upon where the underlying market's price is. So if you're trading the US 500, then it's going to be based on the S&P 500 E-mini futures, and they'll tell you what month. So they may say, December or, March, or just whatever month that they're working off of at that point. So, and it's literally right there in the platform. And like I said, I'll do a whole platform training for you as well, and I'll record that and I'll put that up for you. And then what you want to do right here is look at this simple illustration at the bottom right. See where it says like ceiling and floor, and a reminder at the bottom of your screen there's a thing where you can click to enlarge your window just for the webinar here. So if you want to use that, you can use that and it'll make it bigger for you. But there's a ceiling and a floor. Okay, the floor is basically defining the bottom, the ceiling is defining the top. It's just like the two strikes. Okay, so the floor and the ceiling are defined by the strikes that you do, and I'll show you examples of that. So the width or range of the spread is determined by the spread's maximum value. The upper and lower range of the spread is called the market ceiling and the market floor. A spread will be quoted in points. A point is the last digit in the quote. So let me show you what I mean by all that. All right. A point is the last increment the product is quoted in. So let's say crude oil is quoted in dollars and cents. So 104.58. The last digit is 8. So that is the point that it's quoted in. So a spread example would be 104.58 to 105.58. That'd be a 100-point spread. It's $1, right? 104.58, 105.58 minus 104.58 is $1. And since 8, the last digit there is pennies, okay, the point is always the last number. So it's a 100-point spread because there's 100 points that it can go up. It has to go 100 points up from 104.58 to go to 105.58. The Wall Street 30 doesn't have any decimal points, okay? It's quoted in whole numbers. So 12,213, for instance, the last digit is 3. So 3 is the point the spread is quoted in. A spread example would be 12,213 to 12,313. That'd be a 100-point spread. So in both cases, a 1-point move is the last digit. All right? So, if you need to watch this on the replay, rewind, whatever you can. But literally, it's the last digit is a point. So, think about what anything cost. The very last number is the point. Okay? And so the difference between 12,213 and 12,313 is 100 points. Therefore, it's a 100-point spread. The width of the spread is the spread's maximum value, and every point is worth $1. It doesn't matter whether you're looking at Forex or gold or indexes or anything. This makes it really simple. You don't have to worry about what a tick is worth and what a pip is worth and whether it's in cents, dollars or euros or whatever. Every point is worth $1. Okay? So a 100-point spread, 12,213, 12,313, is a $100 spread. That's the maximum value of the spread. So if you had to pay $25 to get into the spread, that'd be your maximum risk. You have to put at the maximum risk, you have to put $25 up. If it's a 100-point spread, your maximum would be $75, because remember, the maximum value is $100. So if I got to pay $25 for a $100 maximum spread, the most I can make is $75, the most I can lose is $25. Okay? Now, I could also do 100 of them, so I can make $250 or lose $250 or make $750. All right? The spread is going to expire daily, and they'll have several times during the day they expire as well. So they may have a 10 a.m. and a 12 and a 2. Okay? So there's several different times of the day that they expire. And we'll go over some examples of that. And they'll also give you different widths and ranges of the spreads. And here's a tip for you. I'm sure I'll get to this, but let's say a spread starts trading at, 12 o'clock. Okay? And let's say it's a 2-hour spread. So that means it trades from 10 to 12. Then that means what will happen is at 9:55 or so, the spread values will come up. Why do they do that? Why do they wait 5 minutes before the spread? And I'll back up on that again. If a spread expires at noon and it's a 2-hour spread, okay, so it's an intraday spread, that means it starts trading at 10. Because if it expires at 12 and it's 2 hours, it starts at 10. And by the way, on Nadex, everything is Eastern time. Okay? So that means that at 9:55, they're going to post the spreads, and I can start trading them at 10. All right? And I can't trade them 15 minutes before they expire. So at 11:45, I can no longer trade them. So I'm basically wait until settlement. All right? So I can get in as early as 10 and out as late as 11:45, or I can wait till they expire. The reason, I want to get back to the original question, the reason that they don't post them until 5 minutes before 10 is because they're trying to make sure they're always spreading in the money, okay? So if a product is trading at, 12,213, then they may quote a 12, let's say 12,200, 12,300 spread, okay? Whereas if they posted them all at the beginning of the day, then you could have all these spreads that were out of the money, all right? And, they need to be in the money for you to trade them effectively. There's a lot of different ways to trade them, but basically you want to trade in the money spreads, okay? So they're going to post them right before they start trading, and then you can see them right then, all right? They also have ones that are good for the entire day. So there's ones that you can see first thing in the morning. When they post them, they do that so that way they can basically put all the spread prices around where the market's currently trading. The option contains a range called a ceiling and a floor, and that sets the limit and the risk on your reward, okay? So like I said, if it's a $100 spread, you bought it at $25, then you'd have $75 potential profit. If it goes outside the range, it doesn't increase your risk. It also doesn't increase your reward, okay? So the max you're going to make is up to that ceiling. The max you're going to lose is down to that floor. But if it goes below the floor or above the ceiling, you don't make or lose more. That's the exact same thing as a bull spread or as a put spread or a call spread, okay? So basically, you don't have to worry about losing anymore, but you won't make any more. People go, well, so that caps my risk. Well, so do bull and call spreads. Well, I want to trade the S&P E-minis, and I'm not capped on my profits there. Well, yeah, but you're also not capped on your risk, all right? And how much do you really expect to make? Yeah, there are the days where you make 10, 20, 30, 40 point moves on, say, the S&P 500, okay? But you can also place multiple spreads that day. So every time new spreads come up, you can place another spread. So you're not capped in your ability to keep making money. You're just capped on that particular spread, all right? The other thing is, are you really going for 30 points every time? Yeah, we all want 30 points every time, but a lot of times you're going for 5 or 10 points at a time, okay? So if that's what you're doing, then, do you really need to have unlimited profit potential? Because the market's not going to go unlimited up or unlimited down in one day. So though it can move a lot, and yeah, there are advantages to that, does that outweigh the unlimited risk, the whipsawing that you get, things like that you get on normal trading? But again, just like a normal, put or call spread, defined risk, defined reward, but no theta. Okay. This is Yossi is the CEO of Nadex, and one of the ways that he defines limited risk is one of the articles that he wrote. It said, unlike the large unlimited risk products by traditional futures exchanges, Nadex contracts are not margined. They are fully paid up front, and they have limited risk-reward profiles that are attractive to both startup and seasoned traders. So what he's saying is, you don't have the unlimited risk, going on, and you don't have to put up margin, but you're really risking more money. What you put up is what you risk. So I know I'm going over this over and over again, but I want you to get what you put up is what you risk. You're not risking more than what you put up, but you still get massive leverage buying power, okay? So let's look at how the spread's price is determined. The spread's value is never going to exceed the width of the spread. We talked about that, right? And every point is worth $1. So if it's 100-point spreads, it'll never be worth more than $100. And I'm going to go over these. I just want to make sure you get this down. So on a spread on the Aussie dollar with a 100-point range of 1.030 to 1.0400, that'd be the floor and the ceiling, you have a 100-point range. It's a $100 spread. So the spread ceiling is 1.0400, and it's currently trading at, say, 1.0320. Okay? So the floor is 1.0300. So if you're buying it, the spread, if you're buying, then the cost of the spread is the risk. If you're selling it, by the way, the cost of the spread is the risk too. Okay? So to get this, simply calculate the current Aussie dollar spot price, 1.0320, minus the floor. So 20 points. $20 is your maximum risk. That's your approximate cost of the spread. It may be $22 because you have bid-ask spread and things like that. But bid-ask spread, what you can buy and sell at and things like that. But it should be about $20 if it's 20 points. Remember, the point is the last digit. If it's 20 points in the money, and in the money being above 1.030 or below 1.0400, then that's how you calculate it. So you're looking at $20 risk on the trade. So if the spread's maximum value is $100 and every point is worth $1, it's 100 points. The maximum risk is $20, making the maximum profit $80. So remember, it's a $100 spread, cost $20. Therefore, the profit is the difference between $100 and the cost, $20, $80. Okay? If you're selling the spread, the maximum risk on this spread, if you did this exact same spread, would be $80. That's between the current spot price, 1.0320 and 1.0400. Okay? And the maximum profit would be $20. That's between where the spot price, the FX is trading at, and the floor, 1.0300. Okay? So, now, that doesn't mean that you never want to take the $80 trade. Maybe you do, maybe you don't. Remember, there's multiple spreads, so you may choose a different strike range, okay? But I just want you to see whether you buy or sell it, your risk and reward is completely and easily defined. A spread that has the underlying trading between its floor and its ceiling is very like to be trading point for point. So, not accounting for the bid-ask spread. So the closer it is to the inside that floor and ceiling, the more close it is to the middle of it, the more you're going to get dollar for dollar. As you get to the edge, maybe when it moves $1, it's the spread only moves up 80 cents or something. But what I want you to do is, I really, as an education person, I don't want you to get caught up in that, because it's not going to affect you. In the sense of, does it affect the pennies? Yes. But you're losing sight, sort of like, you can't see the forest through the trees. Okay? So just look at a $1 move is a 1-point move equals $1. Okay? And just focus on that. And then, if the underlying, now the only time it's going to affect it is if it's outside or very close to the floor or the ceiling. Then you have the optionality. And really the optionality exists because, think about it, if something is like $1 away from the floor, well, yeah, you want to buy that thing because you have $1 risk and a $99 reward. But if you're going to buy it, somebody else has to sell it to you, which means they have $1 reward and a $99 risk. Okay? So they're going to build in the bid-ask spread, and that's where the optionality sort of takes over, where maybe it's a $7 risk if it's like right there, at the ceiling or the floor or outside of it, okay? But as you get in it, you're going to see more dollar for dollar. Again, don't miss the forest through the trees. Just focus on, trading the way you want to trade them. But that's just to let you know why, if you see like it's right there, why is it not moving the exact same way? But I part of me hesitates to bring it up because it feels like it makes it more confusing, but I want to make sure you understand it, so that way if it comes up, you know what's going on. But what you need to focus on is dollar for dollar move in the money, and you'll really see that as long as you're, a bit in the money on either side, basically, a little bit away from the floor or the ceiling. If any of this is confusing, please ask questions on the forum, okay? So now let's look at some actual examples, all right? This is daily crude. And I just, basically put this together so we can, see how one works. So if we're looking at crude, and remember it quotes in dollars and pennies, right? So like $80 and, 1 cent or whatever. And the floor for this spread is $75. The ceiling for the spread is $80. All right? And this spread is going to expire at 2:30 Eastern Time. Okay, so we're looking at a $5 spread. So what is the maximum value of the spread? 80 minus 75 is 5. And what's the point? The 0 over there all the way at the end, right? So there's 500 points in the spread. 500 cents, you could say. There's 500 points in the spread, so the spread is worth $500. All right? So if we look at the spread, and let's say we're going to buy it when it gets to 75.25. All right? And maybe it's 25 right now. There's a little optionality. It's really close to 75, so we buy it. Our risk is $25. If we buy it for 75.25, okay? Let's say crude is trading right around 75.25, that's when we bought it. So we bought it right before the screen came up. The market was at 75.25. Well, on this, if it drops, then you have a big risk. But what's my reward? $25 is my risk. $475 is my reward. Okay, $475 being the difference between $500 and the $25 I bought it at. If I bought the outright crude futures contract and it did this, I'm probably getting stopped out. Okay? I'm out of my trade. It's already dropped, an entire point. That's going to be a lot of money in futures, especially depending on how many contracts you have on. So you're stopped out of the trade. Okay? You're down and you're out. But later, it comes up. I was right. Man, I bought at 25 and I bought at 75.25 and the thing literally ended higher and I should have made money, but I lost money. Well, you didn't if you were using the spreads. You did if you were trading the outright oil futures. You got stopped out before you got back, and maybe you got back in, but you had to go through those losses to get there. Okay? So understanding that, let's look at a couple examples. What happens if it goes all the way up? Well, I max out the value of the spread. I make $475, right? Because I bought it for 25. So I make the difference between 25 and 500. 500 is the number of points in the spread because it's a $5 spread, and the point is the last increment in the dollar, so a penny. So I made $475. Great. Okay. Now let's look at what happens if it goes up and down. Do I have to wait until the thing expires? No, I can sell it anytime. So if I buy it at 75.25, and let's say this is what happens over the course of the spread to expiration, okay? And let's say it expires at 77. Well, if I held it to expiration, I'd make the difference between 75.25 and 77. So what is that? Well, that's 200, okay, minus the 25 that I paid to get in, right? So I still have my $25, which is cool. I didn't lose my $25. Like in a normal option, you'd lose that $25 in premium that you paid. Okay, I don't lose the 25. So I still have my 25, plus I still have the 175 I've made. So I have $200 left if it expires at 77 when I bought it and I left it, and at 2:30 expired, and boom, $175 additional is deposited into my account. Plus the $25 I put up is released. Okay. Now I could also sell it earlier. I could sell it when it's at 76.10, and I could make the difference between 76.10 and 75.25, and the difference between that, if we pull up a calculator, just to have a little fun here. So if I pull up a calculator and I do 76.1 minus 75.25, I get 85. So I made 85. Remember, every point, I got 85 points. I made 85 points. How much is a point worth? $1. So I made $85 on a $25 trade. Not bad. I tripled my profit. Okay, more than tripled. That's a great risk reward. Wouldn't you agree? So what about later? Maybe I, don't want to sell it at 76.10. Maybe, and you called it. You called it at 78. That's where you're like, you know what? Based on my diagnostic analysis, which we're going to be going over in a couple weeks, there's a lot of Fibonacci levels here and support levels here, and just all these other things lead up, and it's a round number, and people, they place a lot of orders at round numbers and things like that. So when it gets to 78, I'm selling. You sell at 78. So what happens? Well, we take our calculator. It's pretty simple. 78 minus, where do we buy it at? 75.25. $2.75. 275 points. Okay? So 275 points times $1. I make $275. Not bad on a $25 risk. Okay? An outstanding risk-reward ratio. Are all of them going to come out this way? No. But the thing is, your defined risk. You know your maximum profit. So you can do a lot more trades with a lot less concern about getting whipped out all the time. Okay? And, maybe like it went up there and you're like, I should sell at 78, and you just didn't pull the trigger for whatever reason. Comes back down to 76.60. You can get out. And what happens if you do it at 76.60? And I know this is sort of redundant, but I want you to get it. 76.60 minus 75.25 is 135 points, right? Because every cent is a point. So if you have 135 points times $1 is obviously $135. So I made $135 on a $25 risk. You can't do that when you trade crude oil futures. Okay? You can't do that when you're trading like an oil ETF. All right? You're going to get whipped out. This eliminates you getting whipped out of the trade. You just can't have that risk and that reward without having any increased risk. So, it's just great because it limits your risk, you outcaps your reward, but who cares? You made $135 on $25. That's over a 500% return on your investment and your risk. So, not just risk, but investment and risk. Okay? Because they're one and the same thing. So now let's look at, let's see here, spread option contracts. So, what can you trade them on? Well, they're stock index futures, okay? And those would be similar. If you're a stock trader, they'd be like ETFs, all right? If you're a futures trader, that's going to be S&P E-mini, things like that. Those are the more popular ones. And they're spot Forex. There's no limits, man. You can trade as much spot Forex as you want to. And there are some limits on futures and commodity futures, but, man, they're so high, don't worry about them. If you're worried about them, then let us know and we'll let you know what they are. Or you can hop on, and there's easy ways to find that. But you basically can, when you open an account, you can see it, or you can even hop on their website and see it. But unless you're going to be trading, you're going to be flipping like $100,000 or whatever. You probably are not going to have to worry about the limits. Okay. So stock index futures. And just to go back, if somebody's worried about what I mean by limits, that means like how many can you do? And by the way, there are limits in futures markets also, because we're not going to let somebody own the wheat market or own the oil market. Okay. So, Forex has no limits. There's no limits in currency, but there are limits because they just don't want somebody owning a market. So it sort of applies the same way. That's why there's limits, but that's not uncommon. And even when you buy so much stock, if you buy a certain percentage of stock, you're going to get a letter, or you're going to have to file your intention with the SEC. Are you trying to take this company over? What's going on? So there's limit rules on stock even. But unless you have really big accounts, you usually don't have to worry about that. Okay? And really, really, really big. All right. So again, I like to make you aware of things. If that seems like too much, just let it go, because it probably is never going to affect you, but it's there. Stock index futures. Okay. United States. They have the Wall Street 30. Okay. It literally mirrors the CBOT E-mini Dow 30 futures. Okay. So the Dow 30, that's what the Wall Street 30 is. So it's pretty easy. The only 31 on there that says Wall Street. US 500. That's the CME E-mini S&P 500 futures. So if you want to trade the E-mini 500 futures, here's how you can trade them with completely limited risk. All right. If you want to trade the NASDAQ 100, here's how you can trade them with completely limited risk. US Tech 100, okay? If you want to trade that, I love trading the Russell, okay? It moves great. I like it a lot. I'd say the S&P E-mini and the Russell are my two favorite indexes to trade. And now you can, instead of having to trade them on the futures market and getting whipped out and everything else, you can trade them on the US 500 or the US Small Cap 2000 spreads on the Nadex. So there's a couple products you can trade. You want to go international, okay? You want to trade different hours, things like that. They got Europe. They have the FTSE 100, which is based on the Life 100 index futures. They have the DAX, which is Germany's big index. Okay, so the Eurex DAX exchange. If you want to trade Asia hours, okay, that's like 6 to 10 type thing or whatever. You can go and trade the Japan 225 or the Korea 200, which is the Kospi or the Nikkei. You may have heard of those before. So you can actually trade those. Sorry about that. I'll go ahead and turn that off. Anyways, so got to let that on your own webinar, right? Okay, so the next thing we got is commodity futures contracts. On commodities, you can trade crude oil. You can trade natural gas. So if you want to get into oil and gas and stuff like that, now you can do that, but without this big risk and complexity. If you want to trade gold, obviously one of the hottest products to trade right now. If you want to trade silver, I don't like trading silver on the regular futures market because, I mean, silver is really choppy and it can get whipped out a lot. But on this, it's great because you can still trade the signals, which are usually good, but the stops aren't necessarily great because it just whips around so sporadically. This gives you a chance to get into that market. Copper is an awesome thing. If you want to trade copper, you want to know when to trade copper, hop on our website. We actually have a thing on there that shows you basically like current, market news and stuff like that, and today's news. And, there's a lot of websites you can get that, but anytime there's a housing market, like new home sales, home permits, building permits, construction, stuff like that, when those government announcements are coming out, that will move copper because houses use a lot of copper. So that is like just a great way to trade copper is the days that you see that. So just, sort of a seasonal analysis thing. I trade copper when the housing market announcements are coming out. Agricultural, if you don't trade corn, if you don't trade soybeans even, you can trade that with the spread contract. So you have access to all these different commodity markets, but now without all the complexity and without the unlimited risk. Spot Forex, the 8 major currency pairs. So, the Aussie dollar, Euro dollar, and then, Euro yen, Pound US, US Canadian, US franc, US yen. So all these products you can trade. So you can trade all of them in one account without having to have a futures account and a stock account and a futures account, without having to worry about all these weird margins, without having to worry about ticks and pips and cents, without having to worry about getting whipped out of your trades. All of this stuff in one account. Okay? And I'm actually going to walk you through step by step how to sign up for an account too. Nadex bull spreads, time frames. Okay? So there's duration and expiration. So basically intraday, they can be as short as 2 hours. They can be all day. All right. A daily one is going to end at the end of the current trading day. And when it starts trading, okay, so it's a 2 hour trade. Like I said, if it's 2 hour expiration, it'll start trading 2 hours before. So if it expires at 10, it'll start trading at 8, and the spread prices will be posted at like 7:55, all in Eastern time. Okay. And they'll expire on that day, and at the time of expiration, that's when they settle. Okay. The spread range and width is between the floor and the ceiling. We talked about that. The number of contracts or the number of spreads per expiration per range. That sounds really complicated. Basically, what they're going to do is they're going to put like 3 spreads. Okay, they're going to put one like right in the middle, where it's going to be like, if it's, let's say a product is trading at 100, they're going to put one at 50 and one at 155. Okay. I'm sorry. They're going to put like if a product is trading, we'll make an easier example. If a product is trading at 1,000. Okay. Then let's say they put a spread at 900 and 1100. Okay. But then they may have one lower that's at like say 850 and 1050. And then they'll have one that's higher, let's say at like 950 and 1150. So they'll put one a little bit higher, one a little bit lower, and one in the middle. Important point to note. If I'm taking a long trade, I want to take the trade that is where the current price of the market, like the S&P 500 or whatever, is closest to the floor of that spread, because that limits my risk and opens up my profit. All right? If I'm taking a short trade, I want the spread that has the ceiling that is closest to the market price. So when I'm looking at the spread and I see the strike prices, and if I'm long, which one has basically the highest floor? If I want to go short, when I sell it, which one has the lowest ceiling? That's the spread I'm going to probably want to look at, okay? Because, again, that gives me my lowest risk and my highest reward for that trade. Trading hours. So there's times when new trades can be entered into and opened and exited before settlement. Okay, that's what trading hours are. And then there's a holiday schedule. By the way, I'll show you where all this is at on our website for you too, okay? But they're closed like on Martin Luther King Jr. Day, President's Day, Good Friday, Memorial Day, Independence Day, Labor Day, Thanksgiving Day, and Christmas Day. Okay? So what spread ranges are available? There's basically a floor and a ceiling, and it's smaller if there's a shorter time frame. So a 2-hour spread is going to maybe be like 100 points wide, whereas a 4-hour spread may be 200 points wide, whereas they may have a daily spread called the master spread. Okay, that'll be the biggest spread of the day. The master spread will be, say, 600 points wide, because they're trying to make it as wide as possible to encompass what they think will be the total possible movement for that day. All right? So, there'll be different ranges available. And once here's an example for you. So we come in and we got a few different examples here. The daily is the yellow. That's the 1.3300. So literally like the yellow, like here to here is the daily spread. It's the big wide spread, 600 points. Okay, be 3,300 minus 2,700. And then we have 8 hour. That's the blue. Okay, so there's 3 of them. It looks like there's 4. There's actually 3. So there's one here. Okay, right in the middle. And then there's another one that's like right at the floor of the ceiling and right at the ceiling of the floor. So that's like right at the money. So if I'm going to go long, then I want this spread because it has a lower floor, a higher floor. So like if I'm going to buy it when it's right here, then this little area is my risk and this is my reward. Okay. But if I was selling it, I wouldn't want to do that because then this would be my risk and this little area would be my reward. So number 3, ceiling 3. So we got ceiling 3, floor 3. If I'm selling and say I sold it when it was right here, then this little area would be my risk, but then down to the floor would be my reward. So that's what I was saying earlier when I was saying when I'm buying, I want one with the highest floor. When I'm selling, I want one with the lowest ceiling. Okay? So that's what I was talking about on that. And then when you look at 2 hour, okay, there's less time. So that's why the spreads are smaller. So this has the most amount of time, this has less time, this has even less time. So 2 hour spread, okay, meaning it expires 2 hours after you can start trading it. Then, and are these day trading products? Yes. Do you have any day trading rules, by the way? No. You don't have to have $25,000 on your account. You can have $100 in your account and place these trades, okay? So right here you got ceiling, floor, ceiling. So if I'm going short, then, right here I'm going to want to look at this trade. If I'm going long, I want to look at this trade. Now, if I'm looking for a big move at the same time, let's say all these are available at the same time, would I want this one or this one? Would I want the one that has a higher ceiling or the lower ceiling? Well, if it's at this price point, okay, then does the 8 hour spread or does the daily spread or the 8 hour spread or the 2 hour spread, which one gives me more profit? Well, the daily spread does. Okay, so there's a big advantage in that larger spread if it's really close to the floor. But what's the problem with the daily spread? If I'm going to buy right here, I have risk all the way down to here. Okay, so that's my problem with the daily spread. So I'm like, you know what, I don't want a 50-50 risk reward here. So do I want the 8 hour or the 2 hour? Well, if it's right here, my risk is going to be about the same on ceiling 2 over here on the 2 hour and ceiling 2 over here on the 8 hour. But my reward is much higher on the 8 hour spread. Okay, so I may choose the 8 hour spread. So if this thing just keeps, doing the apex pattern all the way up, then I can basically, keep riding this trade. I can trail my stops and everything and, all that fun stuff. So by trailing my stop, you actually have to choose where you're going to get out. Okay, but there's a lot of ways that you can do that. And, we'll talk about that later. But right now, we're going to focus on just, which spread would I choose? Well, if the price is right here and I had the choice between a 2 hour and an 8 hour, I'm going to go with the 8 hour. Simply because time decay is not working against me, and I have more profit potential and very similar risk between the two. Okay? Settlement. How does settlement happen? Well, they're settled in cash, meaning basically the profit or loss is based on the price where the underlying market, such as on the US 500, where the S&P 500 settled, okay, at that time. And they go through a whole lot of calculations. We don't have to worry about them, but that's basically the bottom line. Remember, bull spread, don't let that confuse you. It's just a spread, okay? So the settlement value is obtained by reference to the expiration value and the floor or ceiling level. So expiration value is less than or equal to the floor, then the settlement value equals the floor. If the floor is less than the expiration value and less than the ceiling, settlement value is the expiration value. If the expiration value is greater than this, but that's really complicated. So what I'm going to do is go back up here. If it expires, okay, at 1 point, let's say it expires 13,100, okay, then I'm going to get the difference between 100 and wherever I bought it. So if I bought it for $25, I'm going to get $75. Here, I'm going to get $75. Here, if it expires at this point, even on the daily, I'm going to get $75 if I bought it for $25. All right, so the expiration, you can look at all that complicated stuff. Bottom line is, where did it expire in relation to the ceiling or the floor of the spread that you bought So that way it determines what your profit could be. Because what if it expires up here at, 1 point, we'll just say 3 or 13.2. Okay, 1.32. Well, I'll get $75 on this one because my risk is my profit is capped. Okay, but I'll actually get $175 because I haven't hit my capped profit on this one. All right, so wherever that expiration price is, that's going to determine the maximum value I could get in relation to the ceiling or the floor. Okay, so floor, like if you're going short. I hope that makes sense. If it doesn't, please ask on the forum. It'll probably make more sense as you actually start trading them a little bit, in a demo account, of course. But at the end of the day, where it expires, how much money could you make? Well, I could make $75 on this one. Expired 175 points above, where I bought it at. So I'm not going to make the 100, but I can make the $75. All right. It expired 175 bucks above where I made it. Well, hey, I can make the 175. It expired way up here, 500 points above. What am I going to make? Well, if I had the daily, I'm going to make, this might be the best example. 500 points above, so it expired at 1.3500. 1.3500. On this one, I'm going to make basically $300 less the $25 I paid to get in if I bought it, say, at 25. And I just keep using 25 to make it simple, okay? Because I could have bought it at a higher price, but let's just say I bought it at 25. I'm going to make the difference between the 25 and the 300, even though it went up to 1.35. Okay. On this one, I'm going to make it between 25 and 1.3250, even though it went up to 1.35. On this one, I'm going to make between 25 and 1.310, even though it went up to 1.35, because my ceiling caps my profit. But if it falls, I can't lose more than the floor. Okay, and that's the advantage of having a little higher spread here if I'm going long, because then the most I can lose is 25. This one, if I bought this one at 25 up here, I actually would have to buy it at 325. So my risk would be 325. My profit would be capped at 275 on this big spread up here. So again, I'll post this for replay. You can watch it over again. But if you just get the concept of ceiling and floor and where it expires, you can get the maximum possible profit based on the ceiling floor, or the maximum loss based on the risk you put up. So if you bought it and it expired, way down here, the most you're going to risk is what you put up to place the trade. All right. So let's look at how settlement determined. All right, this is probably going way too complicated for you, but they take the last 25 trades, the midpoints on Forex, the average between the bid and ask spread, just the second before expiration. Okay, so basically the 25 trades that happened before expiration on the actual market. Okay, and what they do is they add all those together and they divide them. So when I say midpoint, on Forex, so let's say is 1.3400 plus 1.3402. That's the bid-ask spread. If you add those up together, you get 2.6802. You divide that by 2, you have the mark, or the midpoint, okay, 1.3401. So they take all those marks on Forex. So they take the last 25 trades that happened right before expiration. They get rid of the 5 highest and the 5 lowest. So that way no anomalies are just throwing it off. So if you had some weird trade get triggered really high or really low, it doesn't jack up the settlement price, which is awesome that they do that. So they take the 15 remaining, and then they basically round it off to the nearest point to determine settlement. Okay? You can go into the details on the rules. It doesn't really matter. It's going to settle where it's going to settle, but that's how they come up with the exact price. And I'll even show you, there's even a place you can go on there, and you can get where to find what the settlement prices were and stuff like that. But you can pretty much look in a chart, and it's going to be pretty close to that price. So if we took all these prices right here, okay, and we got rid of the, these are all the last 25 trades that came in right before it expired. We got rid of the 5 highest, and we got rid of, the 5 highest here, and we got rid of the 5 lowest trades. And then we added the remaining ones up, and then we divided it by 15. We get this price, 1.024, and, so, but it only trades, let's say, in 1.102 is what it actually trades in. See how, over here, all the prices? Okay, so, this, like I said, basically it's 1.102, so that's where it's settled at, so that's where they're going to determine for the profit and loss, okay? Probably you're never going to look at this again. You're not going to care. You're going to get the chart. It's going to be pretty close to the same price, but if you want to know how that works, there you go, okay? So now let's look at a comparison of a currency spread. Again, don't let the bull spread trick you. Remember, it's just spread, okay? Buy it, it's going up. Sell it, you think it's going down. We're going to compare Forex spot next to a bull spread. So right here, we're looking at pound dollar. Okay. So, if you're looking at this, let's say, through your analysis, you're like, hey, this is a good support line. Sorry, resistance line. And I think basically it's hit this, it's hit it again, it's hit it again. I'm going to go ahead and probably be looking to short this trade. Okay. If I'm going to short this, I'm going to have my stop here. Or, some traders may put their stop here. Let's say some traders put their stop all the way up here. Okay. For whatever reason. Maybe you took the apex pattern and you went short right here. All right. So that was the actual trade that you placed. And this is where your stop is. All right. So if you're trading, and let's say you're getting in right here at this point. So when it opens up on the next bar, you're going short. All right, you're ready. You know what your stop is. Either it's, like I said, here, here, here. And if you're going to have the apex pattern, this would have been where you would have went short if we're assuming that, everything before this was short. Okay? And then, we got all of our little points done. There's our stop loss. Maybe we'll set a little bit above it, point, pip, whatever, above it. So 1.575. And so we have a sell. We're going to go short at 1.5685. We have our stop loss at 1.75. Okay? And that means we're risking $650. Our margin would be $3,138. This is if we're trading this on spot Forex. Okay? So this is what happens. Bam. You're out $650. That hurts, right? You tied up $3,000, you lost $650. All right? And that happens. It's obviously a pretty big trade, but you know what? You did it. It happened. But what happened if you were trading bull spreads and you went short? Well, if you did that, you were down, but you weren't out. Okay? And like what would happen right here? This would be our profit popper, right? So we'd take our profit popper off right here. So if we sold two at this point or at this point, whatever happened, okay, we bought one back right here. We removed all of our risk. It went against us. It hit our stop loss, but we didn't get stopped out of the trade. So it's absolutely amazing how that works out. Okay, and that's just the huge advantage. You were right. It did go down. But they went up and they wanted to snap a few more orders before they dropped it. Okay? They knew there'd be a whole bunch of stop loss orders just sitting right here, drove the market up, it nailed those stops, and then just dropped the market. So you're 100% right, just you were right a little bit too late. Now, if you're trading the strategy and you were trading, FX, then you know what? Yeah, you got stopped out. If you're using the Apex 1 pattern, you could have got right back in right here and went short again. And you would have got the trade. But now, from here to here, you're making your money back, and then you're making some profit. Okay, well, it's really not, but you're down. You got to make the 650 back, and then you can make something with this. You don't have to worry about that at all, and you don't get stopped out, and you still make the money. Okay, so if we look at that example, that 8-hour bull spread, okay, where the pound dollar is at 1.5575 to 1.5825 and expires at 3 o'clock. Maybe there's one at 10, and there's all these different examples of bull spreads that are available. We look at the exact same trade. And our spread ceiling on this case is 1.5700. Okay? Our spread floor is 1.5450. So we got 250 pips, or 250 points, right? Potential profit. Okay? Now we can do multiple contracts, right? We're not limited to one contract. So now here is the time frame, okay? So between 2 and 10. And we just talked about that a second ago. We went over, I was basically explaining that this is the time that the spread can be traded from. So boom, spread opens up. We get in. Here's where it's going to expire. Okay, at 10 o'clock. And we get in, let's say, at this, level right here. So we got in, literally, whether we got in at this level, if we would have gotten a higher level, it actually would have worked out better for us if we would have followed the other trade. But let's just say we got in at this level and a little bit lower, okay? So we're delayed in putting our order on. So we put our order on. We sold 10 at 1.5665. Okay? We don't have any stop loss because our stop is our 35 points maximum risk. Where does that come from? That's the difference between where we got in and the ceiling. So 700 minus 5665 is 35 points. So $35 risk per contract. And we're buying 10 contracts. Okay? meaning our total risk is $350. Remember, we lost like $600 on the Forex trade. So our margin is our risk, $350 versus $3,000. Okay? Then goes up, we're down, but we're not out. And then it drops, expires, right at this area right here. Okay? Sort of nice and convenient, right at our profit popper level there. So trades out, both contracts are out. Okay? So what did that turn out to? Well, we made $760 on a $350 risk, $350 margin, by it expiring at 1.5589. So, what does that mean? Well, let's look at spot versus the spread. On the spot, we risk $650. On the Nadex spread, we risk $350. The margin, the money we had to put up on the spot, was $3,136. The margin we had to put up on this trade was $350. What happened? On the spot, we lost $650 because our stop loss got hit. What happened on the Nadex spread? We made $760. Less risk, less money up front, didn't get stopped out, made money. That's just like a great example to show you the power of using this to trade Forex instead of using Forex. So, using the spreads, the Forex spreads, instead of using the Forex spot market. Okay? And, if we go into more detail on that, we risked $650, made $350, margin of $3,100. Profit, let's say, if we would have had, an actual example where it expired at that point, we didn't get stopped out, okay? $960 would have been what was made compared to the $760. So we made a similar profit, but again, if we would have had the same amount of risk, we would have made way more money, all right? If we would have risked $650, we would have made, closer to, $1,200, $1,300, okay? So, but what was our risk-reward ratio? 1.5 to 1. What's our risk-reward ratio here? 2.2 to 1. What's our return on margin? The investment dollars we have to put up in addition to any floating P&L, 30.5%. Return on margin here, 217% return on margin. And really it's return on investment because you only have to put, your margin is your risk. So it's not like you have to worry about floating P&L at all. So 217% return, 30% return. You tell me which one's a better instrument to trade. So, very, very cool instruments. There's a lot of different markets. There's different time frames. The spread means you can find a lot of different choices. So there's always a trade you can find. You just got to find one that fits your risk reward parameters and, your trading, not strategy, but so much your style, right? And you could use the apex pattern, where you literally look to buy the spread 1 pip above this level. You may get in sooner. Maybe you think it's going to go up. Maybe it's down here and you're like, man, that'd be a great trade. Okay, fine, do it. But here's your risk. Whereas, you'd never want to do that on an outright because, man, you're just asking to get hit. Well, this one, like, if it comes down to here and you're like, man, if it breaks this, I could make quite a bit. I don't just want to make this profit. I want to make this. So, you could literally, if that's your floor and you're ceiling, you could look at this apex pattern and you could use that to trade inside the apex pattern. Okay? And you can use the exact rules. So you can say, I'm going to get in here. Here's my stop loss. Here's my first take profit. And I'm going to get out if it comes back down to this point. And, I'm going to move up my stops and everything else. So you can use the apex pattern on spread options. But you could also use the apex pattern. You could get in earlier. And what's sort of cool is you could literally use the apex pattern. Let's say, like, you could hop in over and over again. Let's say there's like 3 apexes in a row that lost. All right. So you got in again, you got in again. And then on the 4th one, let's say it just took off. Well, normally what would happen? You'd be down 3 trades and you'd be trying to make that money back in the next trade, right? Well, on this, you're down, but you're not out. So all 4 trades could end up profiting. So you can still get in again and again and again. And as long as it happens before the expiration, all 4 trades could end up profitable. That would never happen if you're trading outright, because when you're down, you're out. Okay? So it's very, very cool with the whipsaw, especially if you define your risk by the amount of dollars you're willing to risk in the trade. And, some people may go, well, what about this? This huge risk reward right here, or, this is a lot of risk. How do I do that? Well, you know what? A couple things. One is your size. So if you're willing to risk, $100 and it's a $50 risk from here to here, then only do 2 contracts. Okay. And yeah, this one may only make 25 or 30. But then the next one may just keep going up and up and up until it hits the ceiling. Okay. But, you can do it. There's a lot of different ways you can use them. You can literally use your imagination a little bit because you can use the Apex system to define basically direction, and then you can use the floor and the ceilings of the spreads to define risk. And then you can use the apex system to define when you want to get in on that trade. So, pardon me. All right, now what we're going to do is we're going to talk about binary spreads, okay? Or binary options, not binary spreads. And we'll focus on the Nadex binary options, but also show international students where y'all can access them internationally. And we're going to go over what are they, why, what's your risk reward on them, and they're very simple, okay? The 4 markets you can trade them on, and the time frames, the strike prices, what is all that? How do they settle it, and how do they get the value of it? How does the price change? All that fun stuff. Okay, we're going to go into a lot. And basically how you can use them simply beyond buying and selling binaries. These are actually very, very cool for you. Like, you can go in and do really short trades. I'm talking like 15, 20-minute trades. You can go in and do like 10-minute trades. You can trade them right before news, or at the best trade in the world before news. It's very cool. And that's even a way to use, spreads. If you're going in and you see a floor or a ceiling that's really close to the market and the news is about to come out, you can go in and buy that thing, risking $25. And, hey, if the market takes off, you can make $500. The market drops, you lost $25. So it's a very cool way to go in and limit your risk. And you can do it on the spreads, but also on the binaries, you could play both directions. And we'll talk about a couple of different ways to use binaries. So, again, basically you have risk on other things, but on binary options, you have limited risk. What you put up is what you risk. And one of the greatest benefits is you can trade them in flat markets. So spreads, you really want the market to be moving a little bit. Binaries, you can actually trade in flat or really volatile markets. A binary trade is perfect for flat and highly volatile. So one of those two sound familiar recently? Maybe a little highly volatile going on. And you don't have to worry about leverage in the sense of you're not ever risking more than you put up. So just like the spreads. And if it's not volatile, you can make a lot of money. All right, and you'll see why. And if it is really volatile, you can still use them to make a lot of money. And you can do it in very short periods of time, but you can even trade these up to 1 week. So the other ones were daily and up to, down to 2 hours. These can literally be all the way up to a week or 2 hours or whatever, okay? And they give you access to Forex, global stock markets, multiple futures markets. You can even trade economic events like unemployment. So is it going to be over, is it going to be, basically if they're forecasting this certain price, is it going to be 5,000 above that or 5,000 below that? So that's pretty cool. And, we'll release more, trainings and stuff on different ways to do the binary options. But right now, I just want to make sure you get the binary options down. Okay. So, over the next, several weeks before the 8 weeks is up, I'm going to make sure to give you additional trainings on the binaries. And again, don't get whipsawed out. Don't get stopped out. Your risk is the amount you put up to do the trade. Okay. So what are binary options? Well, they're short-term, fast-moving contracts, and they have 2 possible expirations. So I know like the spreads that can expire based on, how much in the money they are on the spread. These are going to expire. When they expire, they're going to be worth $0 or $100, and that's it. Now, you could do 1,000 of them, okay, or you can do 50 of them or whatever, but for one binary, it's going to be worth either 0 or 100 when it expires. And that sounds a little weird. Why 0 or 100? Well, it's a true or false statement. Either this is going to happen, and it does, or it doesn't happen. And I'm going to show you exact examples of this. You can hold them to expiration. You can exit them before expiration. You don't have to wait till the true-false event, 0, 100 happens, okay? And again, a lot of movement regardless of volatility. You can trade them in volatile markets. You can trade them in flat markets. And you can basically just get a lot of different trading opportunities. The price basically reflects what the market thinks is the percentage probability of an event happening. So, is the market going to be above 1,200? Well, if the market thinks there's a 70% chance that it is, then you're going to pay $70 for that trade, and you're risking 30. But I'll get into that in a second. And by the way, these can be looked at as gambling, or they can be looked at as basically trading. Gambling being, I'm just going to throw money in and see what happens. Trading is actually going to have a plan, okay? And we're going to talk about a couple plans where you can use these to really increase your probability, okay? And there's so many ways to do it, but time decay and volatility are considered in the price. So there's a lot of theta going on, okay? If you're out of the money and not really if you're in the money. Volatility is huge. So, just a small move makes a big difference in the price, okay? But again, 0 to 100 is your cap. So it's not like you can lose more than $100. Really, you can't even lose that much unless you sold it for 100, which means you can make nothing and nobody would do that. So, again, they're a true or false statement. Either the event will happen or it will not, okay? And then it's a fixed maximum risk and a fixed maximum reward. And again, same thing from Yossi. Basically, gets rid of all the disadvantages of the unlimited risk on futures. So the floor is 0. That caps the risk of a long position. Okay, the ceiling is 100. That caps the risk of a short position. They're small. You can literally go in and you'll never risk more than $100, unless if you're doing the maximum amount per contract. Okay, and you only have to do one. Small tick value of $1. Minimum anchor move maybe like 0.25. Just depends upon the instrument. I'll show you how to get that. Okay. And then they're settled at cash value of the option. So there's no delivery of physicals. You don't have to worry about having to buy stock. You don't have to worry about buying commodities, things like that. Biggest thing on here, you could literally go in and you could place a $1 risk to make $99. That sound pretty good? Yeah. So let's look at that. If I bought an Nadex binary at $25, okay, then my reward would be $75, because it's going to be the difference between 100 and the $25 I put at risk. Simple enough. Cost 25, reward's 25. Okay. If I bought one at 50, my maximum reward would be $50. Pretty simple. If I sold one at $75, my maximum reward would be $25. Okay. If I sold one at, if I sell one Nadex binary at 75, the maximum risk is $25 because I'm going to go short. Okay. So my maximum reward is 75. So basically, whatever you sell or buy it for, the difference between that and 100 is the profit that you can make. And again, if I sold one at 50, my maximum profit potential is 50. All right. And just one more example. If I sold it at 75, my maximum, going short, my maximum profit is $25. Okay. I just want you to get down at 0 to 100. Whatever you put up, the difference between that and 100 is your risk. Or, I'm sorry. Whatever you put up is your risk. The difference between that and 100 is your reward. Maximum reward. Okay. You can trade them on stock index futures, spot forex, commodity futures, and economic events. So, same thing about the limit thing. Not going to go into it. Not going to make it confusing. You probably don't ever have to worry about it. Okay. Exact same markets as the spreads. So, Dow Jones, S&P 500, NASDAQ 100, Russell 2000, the DAX, the Life, the Nikkei, the Kospi, all that available to you. Commodity futures, crude oil, natural gas, gold, silver, copper, corn, soybeans, all the exact same things. Spot forex, Aussie dollar, euro yen, pound dollar, dollar Canadian, dollar franc, and dollar yen. And economic events. So, you think the Fed funds rate is going to be, you think they're going to increase it or decrease the percentage? Well, they're not going to be decreasing it, so I wouldn't be betting on that, right? It's already basically at 0. Here in about 18 months, they may be looking at increasing it, maybe sooner. Who knows, okay? They even have the ECB rate, the euro rate, and they actually have been looking at moving that stuff around with all the stuff going on over there, all right? Jobless claims, every Thursday that happens. Are jobless claims going to be better or worse? Well, think about it. We're in seasonal hiring right now, right? So when they report December unemployment claims, they should fall because people are taking on part-time jobs. Also, the 99 weeks of unemployment benefits is running out. That's less people claiming them. So it may be under what they project. Okay. Just, ideas, not recommendations. Non-farm payrolls once a month. So I put the links on here. Also, those are on our website too. So, but just some details for you. All right. So, those are some cool things to trade. If the whole economic event thing is throwing you, don't worry about it. Just focus on, the products you like to trade. Stock index futures, commodities, or Forex. Okay? Duration expiration. So, there are going to be times within a current trading day. They're going to have an ended trading day. They're going to have weekly. And then they'll have the economic event, which is, of course, time to when the event is released. All right? On economic events, basically, they ought to be available on Monday morning for the event that's going to be announced that week. Settlement. Basically, there'll be the date of expiration, the time of expiration, or the end of the economic event. Either it was 10,000 above or it wasn't. Number of contracts, number of strikes. They'll basically split it in half. Half will be in the money, half will be out of the money. Okay. Again, don't worry about that. You'll see them. Basically, is it going to be above this price or below this price? We'll look at a couple examples. All right. Trading hours. That's basically when you can get in and when it settles. And then holiday schedule, the exact same thing as the spreads. The strike prices, it's the difference between strikes. You don't have to worry about that because these aren't spreads, right? They update them daily, weekly, and they even update them throughout the day for the shorter term ones. So let's look at the strike price of a binary option is the level of the underlying market against what the option is settled. Well, that's complicated. In gold, if you're saying gold is going to be above 950, yeah, well, way above 950 at 1:30 p.m., right? Now, they're going to have 950. No, they're going to be closer to where the market's at. So above 1700 or, whatever at 1:30. And I put examples on here so they're, they have nothing to do with current market prices. But 950 at 1:30 p.m. contract, for example, the strike price is 950. So they put it up there. And if it's above 950 and you bought that binary, then you'll make the difference between what you paid and $100. If you said, no, it's not going to be above 950, and again, forget that it's gold, so that way you're not thinking, hey, is it 1700 that makes sense, And I mean, gold's going up and down, 1600 one day, 2000 the next, whatever. If it's above it, then you're the buyer, you make the $100 less what you paid, okay? If you're the seller, you lose what you paid. If you're the seller and it's at or below the 950, you make it. So the at or below goes to the seller, the above goes to the buyer. Okay? And they'll literally list like 23 different strike prices every day for gold. And they'll stagger them at $3 intervals. So they'll put it like 950, 953, 956, 959. Okay? And the intervals and the number of strikes are made available each day, each week, each month. And, basically as soon as you log in, you'll see all the intervals. So you don't have to worry about how complex that is. That'll be in your screen. And like I said, I'll do a whole training and I'll post it for you just on the back office, the platform in Nadex. But, here's an example looking at like the US 500, the S&P 500, okay? And you can see what the price is. So right now, on this example, if the S&P 500 is going to be above 1268 at expiration, then you only pay $2 to buy that. So that's your risk. If it's above it, you make 98. Okay? If it's currently trading right around 1250, 1253, you can tell that because it's closest to $50, 50-50 chance, right? Then, like this one you pay $42.25. It's above 1253, you make the difference between $42.25 and $100. Okay? Well, down here, it's already above that. So $99, you make $1. So you probably wouldn't want to buy that, but you might sell it. Right? Because you bought 99 and it goes below it, you could actually lose all 99. But if you sold it, you'd actually sell it for $3.75, and if it actually goes below it, you could make $96.25. So, basically, you're saying, is it going to be above this price? You're buying it on the offer, okay? Is it going to be at or below this price at expiration? You're going to be selling it on the bid. All right? So, out of the money, strike is higher than the current market price. At the money, strike is close to the current market price. In the money, it's lower than the market price. Okay? So let's look at some ways that binaries can, basically, if there's a big rally in the S&P 500. So it goes from like 1242 to 1254. So look at this before and after. Okay, so before being here, after being here. All right. This went from $2 to $21. Okay. Now if it expired and it's not there yet, which, I mean, obviously, if it's right there at 12, it's not quite at 1255, it'd be 0. But if you bought it for 2, you could have sold it for 21. If you bought it here and sold it there, literally, you're talking a massive profit, like 10 times return on investment. Okay, if you bought the 1243, you could 2 times return. 4150 was your risk. You could make it, a potential 5850. And, but you could sell it at 86. So you could have bought it at 41.50 and sold it at 86. And then, some of these, I mean, if you sold them, like, they're literally worthless now. So you could have, like, your full profit. So, I mean, it's very, very cool. And they settle at 0 or 100. We talked about that already. It's an all or nothing payout. Either you get a 0 or you get 100 if you wait until settlement. Okay? You don't have to wait until settlement. And I'm going to show you some examples that are a little bit more clear. But it does the exact same method. So instead of going into this and, I'm just going to go ahead and skip past this. But they do the 25 trades, take out the 5 high, the 5 low. They average the 15. And that's the last 25 trades before the expiration. And that's where they get the price. Okay? Binary pricing, they have delta. So this is basically the price of the binary. It's the percentage that they believe. So like if it's a 50 delta, it's 50% at the money. Gamma, that's going to change a lot for every point move. And that's going to increase a lot the closer you get to expiration. So a small move is going to make a big difference on a binary that's going to expire in like 30 minutes or an hour. Okay, which is awesome. That's where you can go in for like buy something for $20 and sell it for 80 like 10 minutes later. Okay. Theta, it'll decrease on out of the money, but it won't have any effect on in the money. Okay, it'll sort of increase. It'll become worth more. All right, and then Vega, because if you're in the money, there's a higher probability it'll expire in the money as you're getting closer to expiration. Vega, we talked about all these Greeks on the last thing, so if you're lost on the Greeks, you can go back and check them. They're not really important, but it is good to know how they affect the binary pricing. Vega increases the gamma. The more volatile the underlying is, basically the more it's going to change in price. So as it goes up and down. Interest rate, not really a big deal since interest rates are so low right now. Okay, so you don't have to worry about Rho. Pretty much don't have to worry about Rho at any options at the moment. Euro dollar. So if you go in and you buy Euro dollar, and right now based on where it's trading at 1.3985, you can buy a Nadex binary at 1.3960. You're saying basically it's going to be greater than 1.3960. The strike price is $85. Okay, that means your risk is 85. Okay, so what it'll be greater than 1.3960 at 3. Your risk is $85. Your maximum profit is 15. Okay, so again, your profit is the difference between your risk and where it's at. Pretty simple. So if we look at the same thing here, if we bought one, our maximum win is 15, maximum loss 85. Sort of bringing those risk reward graphs back into play for you. If we sold one, then it'd sort of go in reverse. Maximum win here, 82. Maximum loss, 18. So better risk reward on that one. And again, you could look at different strikes. You don't have to shoot. You don't have to go short. You can go long. Just go long at a different strike if you want to do that. And to bring it all together, if you're selling it, you're saying it's going to go down. It's going to be below 1.3960 at 3 o'clock. Okay. Your maximum reward is $82. Your maximum loss is 18. All right, so price and time. So let's look at this. What happens? All right, so basically, if we're looking at Euro dollar is going to be greater than 1.450. We're buying it if we're saying that. We're selling it if we're saying it's going to be equal to or less than 1.450. Okay. So if I did it right now, I'd have to buy it for 58 or sell it for 54. So if I sold it for 54 and it dropped down, I could buy it back for 46. So this is ask and this is bid. So if I sold it, I'd sell it for 54. I could buy it back at 46. Okay. Well, then if I just held on to it and I'm losing time value, so I'm out of the money. Okay. But then it shoots up. And now I can sell it for 72 if I wanted to. Okay. So if I bought it at 46, I could sell it at 72. And then it drops. Okay. Well, now I could close that for $26. So I could buy it at 26, capture that profit. What's really cool is that I could buy, say if I sold 2 of them, I could buy 4 of them at 26. Well, now it shoots up to 100. And now I literally make, $74, right? So I literally make money from here to here, and then nothing's going on. I make money here. I make money going short. I make money going long. Just a ton of trading, but not doing any kind of massive risk at any point, okay? If it's out of the money, okay, then if I'm, short, notice how it keeps decaying, which is great for me. If I'm long, then, I'm losing right here, right? So if I'm short, if I sold it at 42, then it's worth, 36, then it's worth 22, and eventually be worth 0. Okay? If I'm long, then stay out of the money, it just decayed away. If I'm in the money, and I bought it, and it just stayed, look at this, flat market, not doing anything, okay? I make money. Even though I was long, and it ended lower than where I thought it was going to end. I made money. Very cool. Okay? Flat market, making money. Okay? Now let's look at a volatile market, thing flying up and down. So right here, I go in at 36. I sell it out at 68 if I wanted to, okay? It drops again. I'm like, wow, I can buy it at 24 now. So I buy it. Shoots up. Let's say I sell it at 48. It falls down again at, I buy it at 23. Thing flies up. I sell it at 94. Okay? Falls down again. Maybe I sell it. Maybe I buy it. Who knows, okay? And then falls down to 0. So you could literally play this volatility throughout the day with very small risk and very high reward with the binaries. So you're not necessarily just saying over under at expiration. Okay, you can buy it and sell it when it moves up a little bit, and then when it gets closer to that, where it's cheaper to sell it, like up here, we can sell it for $6, really, because 94, you're selling it for 94, which means you're actually putting up $6 to make $94. Okay, that's a great point to sell because the risk is $6, the reward is insane. There's a lot of different ways to trade them. So there's multiple ways to trade them. So you could enter one at 10 and then enter one at 20, and then you could buy another one at 30. Like one that costs 10, one that costs 20, one that costs 30 at 3 different strikes. Your total risk is $60, okay? But your profit, because each one of them has a $100 value, is $240. So $100 per binary less the $60 risk. So it's $300 minus $60 equals $240. If any of the binaries closes above the strike price of any of the 3 strike prices that you bought the 10, 20, and 30 at, you make $100. That covers your $60 risk. You make $40. If 2 close above it, you make $200 less your $60. If 3 close above it, you make $300 less your $60. So you could literally tier into them. Okay, a great way to fade the market. All right. You could use them right before news, like 5 to 10 minutes before a news announcement. You can literally go in and you could buy one at 50 and sell one at 50, and then put your take profit in, say like at 80 and at 20, and the news comes out and it fires up and down really fast, and you literally can make money on both of them. Great before FOM's, the Fed funds rate, the market usually just bounces up and down like crazy. So a very easy trade to do right before then. Just put both in, get both filled, and immediately put in both your limit orders to take, not all the profit, because you're not going to get all of it. Just go in for part of it, okay? So you can just get both of them in, get both of them out, make $60, 10-minute trade. If you're an international trader, you can go to IBCFD, okay? Or you can go to Sydney Futures Exchange. And there's even some other ones, and I'm going to post all these on the forum for you, okay? If you're a U.S. resident, you ought to see a link on here that says, click here to open a Nadex account. Click on that link, or go to the forum. There's a link there. Also, you can go to our website under helpful links, and this is where all the contract specs are. So like the holiday schedule. You can look at today's economic events, by the way, like that's right up here, okay? You can see the free Nadex account, so click right there. And if you want to get specs on all the contracts, we have all those on our website for you. But free Nadex account, click on that to get a free Nadex account. What will happen is you'll come to this screen. Basically says, hey, you understand that we referred you. We work with Nadex. We do conferences for them. So we refer people to them. That's why you have to do all the disclaimers, all that fun stuff. You click agree, and then you fill in all your information, okay? Once you fill that in, you click I agree. And then it'll say, where'd you find out about us? So you found out about us from Apex. So if we do any specials, then, you're on the list to get those specials, okay? They'll go in basically, do you have any bankruptcies? Do you have this? Do you have that? Whatever. Things that, not really even bankruptcies. I think it's more of like, are you under any kind of investigation stuff? Whatever. And then choose your username and password. And then acknowledge the risk disclosures. Okay, this is what it is, like minutes, okay? You're done. What'll happen is they'll review it the next day, 1 to 3 business days, but usually the next day. They'll reply saying, hey, your account's set up. You don't have to fund it. Obviously, $100 funds the account, okay? But you'll get a demo account regardless. So get the account, hey, I say fund it, you fund it if you want to, but you don't have to put a whole lot of money in to start playing with them, if you just want to play with the binaries or check out some of the spreads. But you can always play with the demo account for free. But again, it takes 24 to 48 hours. So go ahead and make sure you do that tonight. Just fill it out so that way, it, hopefully it can be ready for you by tomorrow, okay? And then when I do the platform trainings, you'll be ready because you'll have access to it. And then when you log in for your demo account, you'll click demo access, and it's demo dash your username and password, okay? There's not like markets and all that stuff. There's limit orders on Nadex. So if you do a limit entry and the market's above, like basically if you want to get in higher when the market is, you need to wait till the market gets there to put your order in, okay? Once you're in, you can put in your take profit order. If you are wanting to do a stop loss, which I don't know why you would, but if you want to do a stop loss instead of using the whole benefit of Nadex, which is not getting stopped out, you'd have to enter your stop loss order when you're ready to get out. You can't just have it standing there, okay? But the big thing is limit order, and then you can always put your take profit orders in as soon as you get filled. Also, on the stop loss, you can just let your risk be your stop or wait till expiration. So that's what most people, would do on that because you're going to have risk anyway. So, but if you want to get out earlier, you always could. So what do we cover? We went over Module 1, S3P3, Module 2, One Pattern for All Markets. Module 3, Forex Strategy, Pips and Pitfalls of Forex. Module 4, that we went over the Future Strategy, Tips and Tricks and Margin Power and all that fun stuff. And Module 5 went into Stock and ETF Strategy, looking down to go up, doing top-down analysis. And Module 6 went over Option Strategy, and we talked about Greeks for gains. Module 7 today we went over Binary and Spread Trading, went over what are binaries, what are spreads, what markets do they cover, how do they work, how do you eliminate commissions, trade on Nadex, how do you eliminate whipsaws? Well, they limit your risk automatically. And they cap your risk by the amount you put up. And then a regulated CFTC US-based exchange, and how to trade binaries and bull spreads. And again, like I said, I'll do some bonus videos for you. And I'll post those up in the upcoming weeks, okay? I just want to make sure they're really good, and I cover every detail. And I actually spent a lot of time talking to Nadex today, just even going over more details to make it even better for you. And, again, homework, open in a demo account with Nadex. Fund it when you're ready. But again, you don't have to fund it with a lot. $100 gets you a funded account and you can start trading. Until then, use the demo account. Play with it for now just to get an idea of how it works. And again, I'll upload the videos in the next few weeks and I'll go over platform trainings and teach you exactly how to do them. Okay. But I hope you see the value of this, and the learning curve is really small. It's sort of a weird product until you get used to it, but it works the exact same way as pretty much everything else you trade. It's just there's a floor and a ceiling. Okay, and the binary spread has the 0-100 thing, but the spreads are just like most things you already trade. Okay, and again, I'll post a link on even how to sign up inside the forum for you. And then in future models, we're going to go over time frames, bar sizes, risk management platforms, and specifically, we're going to be focusing very soon on diagnostic trading. This is the style part, the how to read the markets. Okay. Remember to use the forum to ask questions and sign up for your account, and I will see you on the next webinar.